It's not you. Setting our children up for financial success is one of the hardest problems parents face today. A Brookings Institute study found that on average, middle income American parents will spend $310,605 by the time a child who's born in 2015 turns 17 years old. That's not including expenses like the cost of a 4-year college tuition, which increased an average of 12% annually from 2010 to 2022. But it's not hopeless. There are strategies and habits financially wise parents can use to not just build wealth for future generations, but for themselves. We'll break down 2 examples from real people's finances today and give insight any parents can use in managing their finances. I'm Tom Preston, Chief Market Strategist for tastylive, and this is Money Makeover. Reddit post number 1. I just had my first kid and my bank account hasn't grown at all. How do you invest with new expenses? So this is Cicero. He's a 38-year-old married man with a 20-month-old child. Cicero's wife has been talking about a second child, but he's worried they're not saving enough. He makes about $150,000 a year in a commission-based job. His wife left the workforce to be the main caretaker, reducing household income by about $30,000 a year. And they're spending about $4,000 a month in expenses. Now, Cicero has a mortgage of about $150,000 in a 10-year, 3.15% mortgage. He's making a $1,400 monthly payment and should be paid off in 6 years. And as far as investments goes, he's got $110,000 in a 401k. He's contributing 10% of his income with a 6% company match, and he's got about $112,000 in cash. $86,000 of that is tied up in CDs, earning 5%. I think Cicero is worried about the wrong things, maybe. So when Cicero would see that Brookings number of $310,000 over 17 years, that comes out to about $18,000 a year. But what most people don't look into, and what the Brookings Institute doesn't necessarily make clear, is that the bulk of those expenses come from housing, transportation, and food. And in Cicero's case, if he only has 6 years to go on his mortgage, his first kid's going to be about 7 years old, and a second kid is going to be, 4, 5, 6, whatever. Cicero's going to have his housing costs solved. And if he pays his cars off in that time, he's got his transportation costs solved. So the incremental cost of that second child, well, yeah, it's going to be a lot more work for you and your wife. But as far as the expenses go, I don't think they're going to be nearly as big as some of the Brookings or U.S. Department of Agriculture numbers suggest they will be. I think Cicero's worried about the wrong things. Now, if I were in Cicero's position, there are a couple of things that would jump out at me. First of all, he's earning 5% on CDs now in 2023. But the market's projecting lower interest rates in 2024 and beyond. He may not be earning 5% at a bank next year. So if he's counting on that 5%, that's not necessarily a great strategy. So if Cicero is looking to get between 5 and 8% a year return on his investments, but he thinks that, there's not a great chance of keeping that 5% in the next year or so from his CDs, he needs to start looking at things like dividend paying stocks that give him a decent return on his investments, or long exposure to the US market to participate in the growth of the US economy. With a very young child and maybe adding another, Cicero is looking for ways to build wealth, not just for them, but for him and his wife. Our next post talks about the results of when parents do that for their kids. Reddit post number 2, my parents invested for me when I was 6. Now I have $950,000 and don't know what to do. This is Diana. She's a 27-year-old woman, single, no kids. She makes $200,000 a year. That's great, Diana. It's $140,000 from a 9-to-5 and $60,000 from a side hustle. Again, bravo, Diana. She spends about $3,200 a month on expenses. She invests $7,000 a month and has a low risk appetite. Her portfolio consists of a $950,000 net worth. It's $350,000 from personal saving and investing, and $600,000 from parents who invested in a UTMA and 529 account for her. So what is a UTMA account or a 529 account? Well, a UTMA is Uniform Transfer to Minors Act, and it's a way for an adult to give money to a child in an account, manage that money on behalf of the child, and then the child takes control of that money when they reach 18. A 529 account is an educational expenses account. It lets an adult put money into an account for a child, let it grow tax-free, and then when the child goes to college or has other eligible education expenses, the child is able to take that money out and not pay taxes on the earnings. Diana would love to take a sabbatical, work on her side business, and travel to Europe. What is the financially wise way to take that leap? Can she earn $140,000 a year, for example, off of $900,000 in investments? It's possible, but I think Diana, as a new investor who says she has low risk tolerance, that's probably not going to happen. That's about like an 18-19% return on capital. That's not going to happen without a lot of experience and more risk. So I don't think Diana can necessarily do that, which leads to a question. When is the time for somebody like Diana or anybody to spend some of the money of the pile of money that she has to enjoy life versus leaving it in an account to earn more money? So what's the trade-off? Because we don't live forever, and Diana's young. She has the energy to go travel Europe and take chances to build that side hustle into a real career. Maybe that's the perfect time to do it. So how do you balance that? Everybody knows how to spend money. What Diana and some of the people that I know didn't say is, well, what kind of returns can I get on the pile of cash that I have right now before I spend anything? And what can I do with the money I earn off those investments? So yes, you can dip into that pile and pay for a trip to Europe and have a nice time, and you've done it. You can live with it. You'll have those memories forever. That's great. But also learn how to maximize the returns on investments for a given risk tolerance. If you have low risk tolerance, you'll get somewhat lower returns. If you have higher risk tolerance, you'll get higher potential returns. And Diana, if she hasn't invested before, maybe she thinks she has low risk tolerance, but she really needs to quantify that. And the only way you get that is by doing it. So while she's traveling Europe, she should crack open a book or laptop and learn about some investing strategies, whether, again, buying dividend-paying stocks, getting long the S&Ps, that sort of thing, that are going to help teach her about risk and the return she can get from the market. What am I doing for my kids? Well, I'm not putting money into UTMA accounts necessarily because the tax differential really it doesn't mean that much for me anyway. I'd rather have the flexibility of having that money my own until I'm ready to give it to my kids. But the more important thing is that I actually talk to my kids about the markets. What's going on with interest rates today? What's the price of gold doing? Do they know how to look at bond yields? Do they know what the S&Ps are trading at? My kids do. Partly because they grew up with that stuff. I taught them about probabilities. I taught them about return on capital. I taught them about option strategies. So when they turned 18, it wasn't so much that, oh boy, dad set this money aside for us. No, they opened up their own brokerage accounts and started trading. Because as much as I would tell them and try to teach them, they learned so much more by doing it themselves, losing money, seeing which strategies they found appealing, which markets they found interesting. That's what I gave to my kids. Sure, they'll inherit money when I'm gone, but that's not the point. When they inherit that money, I want them to continue to use the information they've learned to keep growing that money even more. So as a trader, yeah, I have a different skill set than, let's say, an engineer or a doctor or an architect or whatever. But anybody, I think, can learn enough to pass that on to their kids at a relatively young age so that they can learn at 18 what I was learning in my 30s and 40s. They can just shorten that learning curve. And that, I think, is the most valuable thing you can do for the financial future for your kids.